Good evening, guys. It's Friday weekend. It's almost 12 at night. Actually, today after trading, I went to sleep for a few hours, so can't actually sleep. Now, this is a very small video. It is an extension of a small discussion I was having on Twitter with some other traders, and I found it very interesting that a lot of traders don't know a very simple logic of trading options. Why options and why not futures? So topic is why trading ATM options intraday is more rewarding than trading futures. Come back to the brass tacks. Consider Nifty is at 11,650. Now let us see what happens when we trade a futures contract and we trade an options contract. Also consider we are holding the trade just for an hour or so. Since it's a day trade, implied volatility remains constant, theta is not an issue. Okay, so let us proceed. Now let us say we buy one lot in futures, Nifty futures. Lot size is 75. Now delta in option Greeks is the change in the options price or premium due to the change in the underlying futures price. Futures delta is always 1. That is, if the cash spot Nifty moves by 1 point, future is also moved by 1 point. So if delta of a future is 1, 75 lot in futures in Nifty means actually 75 deltas. So if 11,650 call ATM, say it is 100, now an ATM call will have something like 0.5 delta. So futures has a delta of 1, an ATM call roughly has a delta of 0.5, half of the futures. Meaning for every 1 point move in futures, the option will move by 0.5 points. Clear? So delta of one call is 75 into 0.5. It is 37.50. So delta of a future is basically 75 and delta of an ATM option is 37.50. So now for the same trade, we equalize the future and the options delta. So for every one contract in futures, we buy two lots of ATM options. That is, if I have a trade on Nifty, a buy trade, I am buying one lot in Nifty future. If I want to do the same trade in ATM options, I will buy two lots of ATM options, which will give me the same delta or the same amount which a future would have given me. So now let us assume that Nifty goes up by 100 points or goes down by 100 points, and let's see the profit and loss. That is, you buy Nifty at 11,650. Within the next 1 hour, Nifty either goes up to 11,750, which is your target, 100 point above, or it goes down 100 points, your stop loss is 11,550. So for 100 points plus, if futures goes up by 100 points, futures delta is 100. So your profit is basically 75 into 100, rupees 7,500. If future falls by 100 points, opposite, 100 point loss, so you lose rupees 7,500. So for the same trade, if it goes up 100, you gain 7,500 rupees. If it falls 100 points, you lose 7,500 rupees. So your risk reward ratio is 1:1. Clear so far? Okay. Now for options, since delta has been equalized, the profits and losses would be the same. Will it be the same? Delta of an option is 0.5, so a 100 point up move, you will get 50 points. We have two options since we have equalized delta, so the option also gain or lose 7,500 for a 100 point move, correct? Because it's 111,500 call, sorry, 11,650 call. Wrote this wrongly. So for 100 point, futures goes up 100 points, options delta goes up by 50 points, profit per lot is 75 into 50, 3,750. For two lots, it's 7,500 profit. For 100 points loss, futures goes down by 100 points, option delta goes down by 0.5 into 100, 50 points. Loss per contract is 3,750, so for two lots it's 7,500. It looks option will lose similar to that of a future. Now this is totally wrong. Why? Now see the actual Greeks. I will just increase this. This is taken from the software called Options Oracle by Santosh Pasi. It gives you a live Greeks analysis of the market. I'm trading on the 11,650 call. Concentrate on this part. This one. And if you see, the delta of this particular call is 0.5. As I said, that is 50 delta, correct? So that is why I am basically equalizing my delta according to the options. Now let us see what happens when the call, let's say it goes to 11,750. That is, it is 100 point in the money. If this call is 100 point in the money, what would be the delta of this call? See, the 11,550 call now is 100 points in the money. The delta of that call is 0.645. So, if the 11,650 call, when we bought Nifty futures, was at 11,650, if it goes up to 11,750, your delta of that call would be probably like 0.65. Go to the next pick. So, if I go back to my calculation, 11,650 call, if becomes 100 points in the money, delta will become 0.65. So 100 into 0.65 is 65. So profit per lot is 75 into 65, rupees 4875. So for 2 lots, 4875 into 2, we will gain rupees 9750. Now what happens if the option goes down? This picture will tell you. If it goes down, the 11,650 call becomes 100 points out of the money on the lower side. So the delta of that particular call will be equivalent to the 11,750 call, whatever the delta is of now. See, the 11,750 call is 100 points out of the money as of now. That delta is 0.32, right? That is the calculation I have done out here. So the 11,650 call is 100 points OTM, delta has become 0.32. 100 into 0.32 is 0.32, 75, 32, 2400 for 2 lots, 4,800. So if I lose, that is if Nifty goes down by 100 points for 2 lots in options, I will lose rupees 4,800. If it goes up by 100 points to 750, I will gain rupees 9,750. Your risk reward is perfectly 1:2. Now this is extremely important and fantastic because futures RR was 1:1. For the same trade with ATM options, risk reward is 1:2. Now say you are correct 50% of the time, that is 50% of the time you get a 100 point profit, 50% of the time you are getting a 100 point loss. In futures, it's zero returns because 50% of the point you will be correct, you will be making 7,500 per trade, 7,500 into 5 positive. 50% of the trade, if you are doing 10 trades, you will lose 5 trades. So 7,500 into 5 minus. So it is equal, but you will also incur some cost. Now the cost factor is also important if you are trading futures. Now this I have used the Zerodha margin brokerage calculator. Let us say you are trading 1,500 in futures. That is, you are trading 2 lots 10 times. Okay. In a week, say you got 10 trades or whatever. So for 1,500 quantity in futures, you pay a STT of 1725, you pay a GST of 125, SEBI charges of 17, stamp duty of 345. If you are trading 1,500 in futures, you will trade 3,000 into options. Say the price of the option is 200 bucks or something. Exactly double you will trade in options because ATM options is whatever be your future lots into 2. You will spend a STT of 300 rupees in place of 1700 rupees. GST you will pay 115 in place of 125. SEBI charges you will pay 60 paisa in place of 17 paisa. Stamp duty you will pay 18 rupees in place of 345. Inclusive of the brokerage, your charges in futures is actually something like 3,000 bucks, and in in options it's something like 1,000 bucks. So you're paying 3 times of your options cost in futures. That's what I have written out here, that futures is negative sum game. You will actually lose 3,000 rupees for those trades. So if you are using a equity of 2 lakhs, that is your capital is 2 lakhs, you are actually losing 1.5% in a week. So if you are using 2 lakhs equity, 10 trades, if you are doing the same trade in options, you are actually gaining 24,750 rather than losing 3,000, because 24,750 is your gross gains. 9,750 into 5 you win, 4,800 into 5 you lose, 1,000 rupees your option cost. As we saw in the pick, you are gaining 23,750. So same trade, 50% win rate. In futures, you are losing 1.5% in a week. Say you have got 10 trades in a week. In futures, you are gaining almost, in options, you are gaining almost 12% per week. Now, along with the cost, if you do this for a year, same trade in future, say you get 100 trades in a year, you are going to lose 78% of your capital in a year just because of the regulatory costs. Same trade in options, this is what you are net making in a week. It comes to 617% in a year. Now, I have of course exaggerated these figures just to drive home the point. The point is, if you trade ATM options by equalizing delta with futures, it's always a win play, because you will make more when your trade is correct, you will lose less when your trade is long. Now I'm giving an absurd 100 point kind of thing. Probably in real trading your stop loss will be 50 point, your target will be like 80 points or something, so this will get even more exaggerated. Now why does this happen? It happens because something called gamma. Gamma is a second order Greek. Gamma is the rate of change of delta. Gamma is highest at ATM strikes, gets lower as we move away from ATM. That is, whether the particular option goes in the money or out of the money, gamma will decrease. But remember, gamma is highest at ATM. So that ATM strike will have a massive change in delta, whether you are making money or losing money. So if you are making money, gamma will help you get more money. If you are losing money, gamma will help you to lose less money. If you want to read more about gamma, here's the reference. You can do the NISF derivative certification. It is the most easiest. Then you read the Bibles of Option Strategies by Guy Cohen, available on Amazon. Then you read Options Volatility and Pricing, Sheldon Nattenberg. Now my aim of this small video is to make you think and point you to the right direction. And last but not the least, this is the jibe. I've spoken to a lot of people on Twitter who talk about machine learning, artificial intelligence, hedge funds and stuff, but I've seen they simply do not understand this simple point. So if you do not understand this simple point in your actual trading and you start throwing jargons like algos and stuff, boss, you are not a trader, you are a faker. So that's the end of this video. Thank you.